severely undervalued, because what we know is a rising gold price is an indication of a failing currency. And the other thing that we know is when they reset a currency, they reset something that has no intrinsic value, this garbage, against something that's all intrinsic value. Inflation's going up faster than wages. So how do you get ahead? What you do is you put your wealth into something that's undervalued. The system does not collapse but evaporates. Well, I think it's probably going to do quite a bit of both, to be honest with you. And it starts from the least liquid at the top, the broadest base, which, I mean, the derivatives. When I counted them before they changed the method for accounting, it was 1.4 quadrillion in notional value. Quadrillion. Nobody knows the true value at risk, but it is the largest part. So once the derivative markets implode, that's it. It's game over. That overwhelms everything. It's a tsunami. So you better hope that that doesn't happen, but it's going to happen, because those are just leveraged bets on underlying assets, derivatives derived from. That is the biggest danger that we face. We have been trained to think that there's the safest thing that you can do. But I would say that they are the least safest. Well, they're not the least safest thing that you can do, but pretty darn close, because 1 trillion times zero is zero. So they can print all of this money to repay you, and that money you can't go and you can't buy a cup of coffee. You can't, there's no place for you to spend it. You need real money. Although your coffee you're going to buy with silver. Then, of course, there's currencies, the power currency illusion. But the single most liquid is your physical gold and silver. And that's power money. That's real wealth, because it has the broadest base of functionality. It is used across the entire spectrum of the global economy. So there's always demand. Maybe more, maybe less, but there's always demand. That's why it's never gone to zero. The same cannot be said for any of these pieces that they've created, because they're all made up. There has been, since 2014, an 86% surge in the size of this bond market to around 23 trillion. Okay, I mean, that's a substantial increase. And there's also been a substantial increase in money to buy these bonds. But Treasury market flows could be volatile for some time due to the economic risks associated with the Fed's inflation problems at home. You see, I've been telling you this for a long time. They're between a rock and a hard place, and it doesn't really matter what choice they make, they're going to make a mistake. Doesn't matter. You know, they're backed into a corner, and they have to raise rates and run, well, they don't have to run off their balance sheet, but they have to raise rates to save face, to save their credibility. Because in a con game, confidence is everything. It's everything. And they want you to believe that they can do this. So for their credibility, they're going to raise rates. But at the same time, all of that debt that they have encouraged, particularly since 2008, well, guess what? That debt has to be rolled over, it has to be serviced, or it has to default. And that's what we're coming up to right now. The Treasury bond market froze in 2014. And so the answer was to allow more players in. And in order to do that, they had to lower the requirements. So that's what we're talking about here. The New York Fed in November 2016 cut its minimum net regulatory capital to $50 million from $150 million. These backstops were put in place in 2008 to prevent another repeat of that crisis. Yeah, well, all of the backstops that they put in place, other than the bail-in laws for depositors, because we're not too big to fail, have been reversed. Pretty much all of them. I can't say 100% all of them, but most of them. if they even got implemented. So many were reversed without even getting implemented, even, 8 years later. So they allow riskier players in. And the one that they're particularly talking about is ASL Capital Markets. And it joined that elite club. So there you go. They're all about the repos. And we know how much that structure has grown over the last couple of years, really. And especially the standing repo, the reverse repo, etc. It's all of this financial engineering that is so complicated, and the truth is nobody fully understands it. Because all they're doing is putting their thumb in this dike and that 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 dike. And what happens when they run out of fingers and they run out of toes? There are no more dikes, and I think they're running out of fingers and toes. I mean, I hope I'm wrong, but I'm not wrong. You can see the market action. You know that's not really true. The Treasury market has begun to display signs that liquidity is ebbing, and that's happening right as QT, quantitative tightening, which means the cost of that liquidity, the cost to take on more debt and create that liquidity, keep those stock markets flying, keep those derivative markets flying, keep the real estate market flying, etc. Investors brace for QT's profound effect on the cost of liquidity. This is just the treasuries that they've put on their balance sheet. Can they run those off? Can the market absorb them? Are there enough buyers out there to absorb this? The answer is no. And what's the effect of that? Higher interest rates. And what's the effect of that? Lower principal values. And what's the effect of that? Higher interest rate. It's a doom loop. It's a self-sustaining doom loop. Fed reducing the qualifications to participate in the bond market because liquidity is drying up, and they need to expand that market. You don't need to do that with gold or silver. You already have that. And frankly, this is what you need in this economic storm, because, my friends, if we're playing hot potato, I'm telling you the game is ending. The punch bowl is empty. You better get to safety. Food, water, energy, security, barterability, wealth preservation, community, and shelter. Get it done. Do yourself a favor. It is critical. We are running out of time. Can you see it?